This is the video lecture for part 2 of chapter number 2, where we're going to be learning how to record business transactions using something called debits and credits. This is also called a double entry accounting system. Double because we have to record two accounts changing, at least two, maybe even more accounts changing, be it increase or decrease. And the total dollar debits in a single transaction has to equal the total dollar credits in that same transaction. For now, we're going to represent an account with this big letter T. So each account, we're going to have the name at the top of the T. And no matter what account, no matter what type of account you're dealing with, this left side is called debit. And the right side, of course, is the opposite called credit. And if you want to abbreviate the word debit, we use the letters DR. And a credit is CR. So sometimes debits will increase this account. Other types of accounts, sometimes credits will increase that other type of account. And here is the general rule to increase or decrease accounts using debits and credits. But let's get a little bit more detail. What's missing here is the other two types. Remember, the types are assets, liabilities, equity, revenue, and expense. So let's take a look at a little bit more detail under equity, including now the revenue type and the expense types. So if you want to increase an asset account, the asset amount, the asset increase is going to be recorded here on the left side of the T. The rule for assets, to put the dollar amount here on the left side. So if you want to decrease an asset account, that account's T, you would record the amount on the right side. The word normal is talking about the leftover balance. Most times you're going to have more increases than decreases, and the difference, the remainder, should be this left side or normal debit balance. Now here's the equal sign, and the rule is just the opposite on this side of the equal sign. Liabilities, though, are still debit left and credit right. But if you want to increase a liability account, you would record the amount here on the credit side. And if you want to reduce the amount you owe for a liability account, that reducing amount is recorded here on the credit side. And if you take the difference between the two, usually more credits than debits, here is the leftover normal credit balance, a positive balance. Common stock also here on the left side of the equal sign, and that follows the same increasing credit or decreasing debit rule. But notice here when you subtract out the dividend account, debit is still left and credit is still right. But because of this minus, the increase and decreasing rule is the opposite. To increase a dividend, you debit the dividend account. To reduce that dividend account, you would put the amount not here as a minus, but you put the decreasing amount here in the credit column. Revenues follow the general rule as common stock and liabilities. Increase with credit, decrease with debit. But for expense type accounts, because of this minus, debit is still left, credit's still right, but to increase an expense, the dollar amount of that expense is recorded on the left side, debit. Again, normal means a positive leftover balance, yeah, be it debit or credit. The same way you increase those accounts. I want you to get a simpler rule than maybe watching this, looking at this illustration here. So let me rewrite this again, hopefully in a more simple rule. Here's that accounting equation again, the same one. Assets are equal to liabilities plus the equity. That's the common stock minus the dividends. This is the first level. And then the second level was assets equal to liabilities plus common stock minus the dividends plus the revenue and minus the expenses. So in the case of this dividends and the expenses, notice the minus. So what I can do is turn everything into a positive amount by moving the dividend and expense over to the left side of the accounting equation. So here's assets again, but now I'm going to add here dividends to both sides. So dividends plus, again, here's a negative expense, so I'll add it to the right side here. Expenses are equal to, remember the opposite of an asset is the liabilities we owe other people. The opposite of dividends we pay is getting money from the shareholder, buying common stock. And the opposite of expenses we incur is the revenue we earn. So can you tell me what's common among assets, dividends, and expenses that we just learned? Well, all three types of accounts. Debit is still left no matter what account you're dealing with. Credit is still right. But if you want to increase an asset or increase a dividend or an expense, you record the increasing dollar amount here on the debit side. It sounds strange to debit an asset, but that's making it bigger, not smaller. Same thing with dividend and expense, increase with debits. And to reduce those accounts, you would put the dollar amount of the reduction here on the credit side. As for the three accounts here, here's one big T for the three types. Debit is still left. Credit is still right side. But because it's on the opposite side of this equal sign, they have the opposite rule of these three. In other words, to increase liabilities, common stock, and revenue, you put the dollar amount here on the credit side. Or to reduce those types, dollar amount goes on the left side, the debit side. So let me re-summarize this again with one big D. I want to increase all my accounts. So here is the rule for all accounts. Debit is still left. Credit is still right. Accounts that are increased with debits are assets. The opposite of an asset we own are liabilities here on the opposite side we incur. To increase a liability, you credit that liability. Here are expenses recorded increase with debits. And here is revenue, the opposite, increase with credits. The dividends we pay back to the shareholders, recorded with debits. The amounts we collect from shareholders to buy common stock is recorded with credits. Again, all these six right here. Again, there's only five types here: asset, liability, revenue, expense. These two right here, really opposites, are considered to be the equity type. Right now, I'm showing you how to increase all of these accounts here, be it with debits or credits. Okay, so let's take a look again here. All I did was move this and this over to the left side to be, because they have the same rule to increase as with assets. So let's focus on just one account. That's our cash account. Again, cash is an asset. And here's the rule for cash. If you want to show an increase to the cash account, you put the dollar amount of that increase here on the debit side. If you want to spend money, spend your cash, you record the credit amount on the credit side of the cash account. Again, here's our T, the name of the account at the top. The left side is the debit side. The right side is the credit side. Every time I put a dollar debit here on the left side, I'm increasing cash because that's the rule for assets. If I want to spend my cash, I don't subtract here on this side like we had done in one column back in chapter 1. But the decreasing, the spending of cash is recorded here on the right side, the credit side of the T. Anytime you hear the word paid, right away I go to cash and put the amount on the credit side, the right side of the T. So if I add up all the cash I collected in the case of for this 1 month of December, here's how much we collected, 36,100. And if I add up all the credits, here's the total cash I spent decreasing the cash account for the month. So if I take the amount collected and the amount I had spent and take the difference, here this difference, that's the balance I have left over at the end of the month after all of these transactions are recorded. Again, the regular positive balance is the same side, the normal balance is the same side, you increase that account, be it an account increase with debits or credit. So again, let's take a look at how we follow the procedure to record a transaction. We have those source documents that are generated by the transaction. Then we're going to start interpreting them, identifying the accounts that are changing, identifying whether the account is getting bigger or smaller. And now, instead of using those T's right away, instead of using those columns, let me show you again those columns we had back in chapter 1. These columns with plus or minuses under each account. We're going to record the transactions in something called a journal. This is like a diary for our business. The specific name is called General Journal. And in each transaction, here's one transaction, we record the date, the 2 or more accounts changing for that one single transaction, and the dollar amount of the debit and the dollar amount of the credit. Then we move on to the next transaction that we need to so-called journalize here in our journal. The date, the accounts, and whether they're increasing with debits or credits. Again, notice these two transactions, at least 2 accounts in one transaction. 2 accounts in one transaction have to be recorded, have to be journalized. And the dollar debits have to equal the dollar credits. If that's not the case, right there is a mistake that needs to be fixed before you move on to the next step. After you accumulate a whole bunch of these journal entries in the journal, the next step is to transfer these amounts into another record called a ledger. Here's our journal again. You can see the arrows pointing into the ledger. The correct term when you transfer the amounts from the journal to the ledger is called posting. You post from the journal into the ledger. So now a ledger is like all those T's we had talked about. Here is one T account for cash. Then you're going to have another T account for accounts receivable, another T for dividends, another T for consulting fee revenue. For each account, you're going to have one T. So now you're taking the amounts from the journal and you're posting, You're posting here into the accounts. Eventually, you're going to get a balance, A balance. So each one of these T's is one ledger account, and you group them all together, and that's called a general ledger, just like a book of all these different pages. One page is one ledger account. Here is our journal again. You can see the transaction, one transaction, another transaction. At least 2 accounts are recorded. The dollar debits have to equal the dollar credit for that one transaction. So again, you look at your source document, you write down the date the transaction took place, and you should record first in the same first row here, the account name of the account being debited. And then here in the debit column, the dollar amount of that debit. We'll go down to the next line and you indent, then write in the name of the account to be credited. And then in the last column, the amount of the credit. One more line, a short explanation describing the transaction or referring to back to some kind of source document. So you now have evidence or proof that this transaction took place. Then you move on to the next transaction and then the next transaction. So the transactions here in our general journal are recorded in chronological order, the order they happened. So again, this is like a business diary tracking everything or mostly everything business transactions our company went through. And here is the next step after recording those transactions. You post it into those ledger accounts. So I represented the ledger just by this T, but now you can see more detail for cash, not just the name at the top and the dollar amount and the dollar amount, but you take the amount from the journal, like this date, you go to the correct ledger account and write in the same date the transaction took place. Not the date you're posting it here in the ledger, but the same date you see in the journal. And in this case, a debit to our cash, you post it as a debit into our cash ledger. A credit here, like this second entry, a credit to cash, you post it as a credit in the cash ledger. It doesn't change. Whatever is debit or credit in the journal is going to be a debit or credit here in one of your ledger accounts. But now we don't have to wait to the end of the month to get a balance. You have a running balance here in the right-hand column. Because this is a new business, you start off with zero cash. And you're going to increase this asset. Remember, that's the rule for cash. Increase it now to a positive 30,000 balance. Here, when you post this $2,500 credit, crediting an asset like cash is going to reduce your balance. 30,000 minus 2,500. Here you can see the reduced balance after this transaction. So at any time you want to know how much you have in this account, all you got to do is update the posting and look at the last balance versus having to just wait, like here, getting this balance at the end of the month. And you're not just doing this for cash, you're doing this for all of your accounts, all of the ledger accounts. Cash being just one of them. Let's look at more detail here. So here's the detailed procedure of how to post from the journal. Think of this as a page of transactions in your business diary to the ledger. One page would be cash, another page would be common stock, another page would be accounts receivable, and so forth. So you take the date and you rewrite and you identify the account. So you turn to the cash ledger page. That's page 101 or account 101, like we had learned in the chart of accounts. Then you write in the same date as you see in the journal. This $30,000 debit, you post as a debit in the ledger. Okay, it doesn't switch to a credit. Debit here, you debit here. This is coming from page 1 of the general journal. There should be a page number up here. So right here in this posting reference column, you show what page this 30,000 is coming from. That general journal, page 1. And because we have a zero starting balance, we just put the same amount, increasing it to 30,000 leftover balance. To show that this entry has been posted in the journal, we take the account number and we rewrite it here in the posting reference column. Just by looking at this, now I know this 30,000 is posted. So if you see it blank, that means this 30,000 still has to be posted. You don't want to miss posting or double post an entry. Yeah, that will throw off the balance here. Okay, so we're making sure we're cross-referencing posting from the journal into the ledger. And all of that is just half of this journal entry. Now we gotta post this common stock credit into the common stock journal ledger account. Same date as in the journal, coming from page 1 of the general journal. A credit in the journal is posted as a credit to the correct account in the ledger, updating this beginning zero balance now, this $30,000 credit normal balance to an equity account. To indicate I finished this posting, I take the account number 307 and rewrite it here in the journal. Now I have completed this journal entry, posting it to the ledger. Now in real life, all of this is computerized. You just have to record the initial transaction and bang, it's journalized and posted. But of course, we want to know what the computer is doing. Computers cannot be automated to do everything. Sometimes they need to be corrected or updated. And to know what to do to correct or update it, you gotta know the underlying process or transaction. And that's why we're learning all this nitty gritty detail of recording transactions. Again, here's the process of recording transactions. You gotta find that source document, the paperwork, the evidence, and interpret that to determine what accounts have to change. And again, the only thing you change is to make it bigger or smaller. Again, this is real life here, source documents. In our class, you're going to be given the transaction. Then you need to interpret the accounts to change. Okay, so we don't have too much source documents being shown. We're just told what the transaction is. And this is going to be true throughout the whole semester. Here's a transaction, journalize it. Here's another transaction, journalize it. We're going to learn lots of different transactions throughout the whole semester. And you got to journalize it. Eventually post it to the ledger to get an updated balance of that account, the ledger account. I'm going to stop here, and the next video, we're going to go through all 15 or 16 transactions that we had saw back in chapter 1. These amounts here. Looks like there's 11. There should be more transactions. But this time, we're going to journalize those transactions and then see how they get posted into the ledger accounts. Okay, so take a look at that chapter number 3. Chapter number part 3 video.